What does the future hold for monetary policy after the Federal Reserve's meeting this week? This question has been on the minds of economists, policymakers, and investors alike. The answer may well lie in a small piece of text in the Federal Reserve's post-meeting statement. This seemingly innocuous clause has been a staple in previous statements, and its potential removal is causing quite a stir. This clause, you see, serves as a kind of compass, guiding the central bank's approach to interest rates. For over a year, it has underscored the Fed's commitment to raise interest rates until its inflation target is met. The statement reads, "In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time," followed by a rundown of conditions it assesses. The removal of this clause could signal a major shift in the Federal Reserve's stance on monetary policy. It could be interpreted as an open door to potential rate cuts in the future. However, if the clause remains, it sends a message of uncertainty, indicating that policymakers are unsure of the path ahead. The impact of this small piece of wording on financial markets is substantial. Deutsche Bank economists have even suggested that changing the language could amount to a meaningful overhaul of the Federal Open Market Committee's post-meeting statement and its direction. This clause has been the subject of much scrutiny and speculation. Just last December, no official expected further rate hikes. Now, discussions around rate cuts are beginning. As Matthew Luzetti, Deutsche Bank's chief U.S. economist, put it, getting rid of that explicit tightening bias is kind of a precondition to more actively thinking about when they might cut rates. This tiny piece of text could potentially unlock the future of monetary policy. A single change in wording could cause a meaningful overhaul. Sounds dramatic, doesn't it? But when it comes to the Federal Reserve's post-meeting statements, such a shift could indeed have profound implications. For over a year now, the central bank has been using a particular phrase in its statements. The phrase, "In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time," has been a clear indication of the Fed's willingness to raise interest rates until reaching its inflation goal. Now, imagine if that clause was removed. This could potentially signal a significant shift in the Fed's monetary policy, opening the door to possible rate cuts in the future. If the clause remains, it may indicate that policymakers are still uncertain about the course to take. This difference in wording is not just a matter of semantics. It has the power to shape the financial markets. These few words can make or break investor confidence, affect currency exchange rates, and even influence the cost of borrowing for businesses and individuals. Deutsche Bank economists have even gone as far as to say that changing the wording could amount to a meaningful overhaul of the Federal Open Market Committee's post-meeting statement and its direction. This speaks volumes about the weight carried by these seemingly minor changes in language. Matthew Luzetti, Deutsche Bank's chief U.S. economist, noted that the removal of the tightening bias in the Fed's language is a precondition to more actively considering when to cut rates. This is a crucial step towards leaving the door open for a potential rate cut as early as March. So as the Federal Reserve considers whether to tweak its wording or maintain the status quo, it's essential to remember that these decisions aren't just about linguistics. They're about signaling the central bank's readiness for rate cuts or its uncertainty about the future. The financial markets will be keeping a close eye on this development. After all, in the world of economics, a single change in wording can indeed cause a meaningful overhaul. The market is eager to know, when will the Fed start cutting rates? This remains the burning question on everyone's mind, especially after the Federal Reserve's last hike in July 2023. Since that time, inflation numbers have been on a slow drift downwards, inching closer to the central bank's 12-month target of 2% by less than a percentage point. This has stirred anticipation for potential rate cuts in the market. However, there's a significant cloud of uncertainty hanging over the financial landscape. Just a few weeks ago, futures markets were almost certain the Fed would start cutting rates in March, assigning a nearly 90% probability to such a move. This was according to the CME Group's FedWatch gauge. But now, the winds have shifted. Recent statements from Fed officials have painted a more cautious picture, indicating a more measured approach about declaring victory over inflation. This cautious approach has left the market in a state of suspense, wondering when the much-anticipated rate cuts will begin. It's like a game of chess, where each move is carefully calculated and every word from the Fed is scrutinized for clues about its next move. The market is watching closely, waiting for the Fed to make its move. But for now, the Fed is holding its cards close to its chest, leaving everyone guessing about its next move. This uncertainty is not just about when the Fed will start cutting rates, but also about how it will navigate the delicate balance between maintaining economic stability and achieving its inflation target. It's a delicate dance, and the Fed must tread carefully to avoid tipping the scales in the wrong direction. As we watch this monetary policy drama unfold, one thing is clear. The timing of the anticipated rate cuts remains a burning question. Chairman Jerome Powell will have a delicate balance to strike in his post-meeting news conference. As the figurehead of the Federal Reserve, he finds himself in a precarious position. His words, laden with the weight of the nation's economy, will be dissected, analyzed, and interpreted by analysts, economists, and the public alike. One of the chief challenges Chairman Powell faces is communicating the Fed's plans and decisions in a manner that is both clear and nuanced. On one hand, he must convey the central bank's commitment to its inflation goal, reassuring the markets of its steadfast pursuit. On the other hand, he must also acknowledge the complex realities of the economic landscape, the shifting sands of data, and the uncertainty that inevitably accompanies any forecast. In the coming months, a key factor that will influence the outcomes of future meetings is inflation data. As the central bank's primary target, inflation numbers carry significant weight in policy decisions. If these figures drift lower, as they have been since the last hike in July 2023, it could signal a shift in the Fed's approach. However, Chairman Powell is unlikely to make any definitive statements just yet. As Matthew Luzetti, Deutsche Bank's chief U.S. economist, has noted, they're going to get a lot of data between the January and March meetings, particularly as it relates to inflation. This wealth of incoming information will be crucial in shaping the central bank's next steps. Powell's task, then, is to leave the door open for future action without prematurely declaring victory over inflation. He must maintain a semblance of flexibility, allowing the Fed to adapt its strategy based on unfolding economic trends. After all, in the world of monetary policy, it's often the case that what's certain today may be up for debate tomorrow. Deciphering the future direction of the FOMC will be tricky without the quarterly dot plot of individual members' projections. Without this roadmap, we're left to read the tea leaves, parsing Powell's words and the Fed's actions for clues about what lies ahead. The journey may be uncertain, but it's a journey we'll take together. One data point, one statement, one meeting at a time. Policymakers are expressing concerns about over-tightening. This concern stems from the current federal funds rate, which being targeted in a range between 5.25% and 5.5%, is restrictive by historical standards. This is especially true when one considers the context of dropping inflation and a rising real rate. Now, what do we mean by the real rate? The real interest rate is the rate of interest an investor, saver, or lender receives after allowing for inflation. It's a fundamental concept in economics and finance, and it's crucial for understanding the true return on an investment or the true cost of borrowing. Now, according to the U.S. Department of Commerce's measure, which the Fed prefers, the real funds rate is around 2.4%. This is significantly higher than what Fed officials consider the long-run real rate. They estimate this to be closer to 0.5%. So, what does this mean? Well, it signifies that the current monetary policy environment could be more restrictive than necessary. The fear here is that over-tightening could potentially stifle economic growth by making borrowing more expensive. This could, in turn, lead to less investment, less spending, and ultimately, slower economic growth. However, it's important to remember that these are complex issues with many moving parts. policymakers have to consider a host of factors, including global economic trends, domestic economic indicators, and the behavior of financial markets. It's a delicate balancing act, to say the least. As we wrap up, it's clear that the Fed's decision will have far-reaching implications for the future of monetary policy, the financial markets, and the economy at large.